Hey, what is up, dudes and dudettes? This video is gonna be a little bit different from my other videos. This video, we're not gonna talk about a small cap stock or, MMAT or NASDAQ in general. This video, we're gonna talk about the future. From today's trading volume and from today's trading situations and from today's trading dilemmas that we face as a everyday trader, we sort of can feel or have a general market sentiment of what other traders are thinking in terms of just looking at the pure data and sort of giving you guys a rundown on what really is going to happen in 2022. And you guys are like, just from about, 1 or 2 days of trading, you already know what's going to happen in 2022. I mean, the entire stock market is actually 3 components. So this video is going to be a little bit educational. So if you don't want to have an educational content, you just want to know what ticker is going up or going down or by what percent, what are the safety range, or all that kind of stuff, this might not be your video here. This is a very educational content. It's very fundamentally speaking. We're going to talk a little bit about macro. We're going to talk about how macro is going to affect the equity market, which is the stock market, and how the bond market sort of influence the equity market a little bit. So every story starts with sort of an observation or a phenomenon. The observation that we observe today is you see all of these tech stocks. They're all red, right? They all went down a lot. Even for Pfizer, vaccine stocks. The reason why for the vaccine stocks to go down is because if you go look at the SEC filings or a lot of the vaccine sale data, no matter if it's booster shot or the previous vaccine sales or how many vaccines were already distributed, how many people were vaccinated, you want to know that as it's like a general data science sort of perspective. When you have over over one standard deviation of the population already vaccinated, that means the potential gain of getting the rest of the population vaccinated is gonna be significantly harder. So how to explain to you guys is it looks something like this. Okay, so there's a concept called crossing the chasm. Wait, let me get the pen out. So usually, right, so there's chasm here, okay? So it's called crossing the chasm. So this is the mean, and then you have one standard deviation over here, there's plus 1 standard deviation, and then you have, this is plus 2 standard deviation. And for those of you who know statistics, you will know that 1 standard deviation covers about 68% of general population, and about 2 standard deviation is 95%, and then, over here is basically 97%, right? And there's a concept called crossing the chasm. So if we use the same exact graph with the same exact standard deviation stuff, you all know that usually this part is called early adapter, which is basically, people like Michael Burry and people like Steve Jobs who are early entry of a certain market or people who started shorting, but those people are not going to be the people who make eventually the most profit. And a lot of people are like, oh my god, Michael Burry made so much money on shorting the market. No, not really. Who really made a lot of money is these people. So these people are the those are the innovators, and those are the early adapters. If you sort of trying to consider this as a product growth stage, this is the growth stage, okay? So this is the growth stage, this part. So if we are trying to describe where tech stocks are at right now, we are really at the top of a growth stage or early adapter. A bunch of boomers or post-boomers or whatever, if they don't want to use the internet, they're never going to use it. And then you have a bunch of even older people who pretty much just can't use the internet, right? They just don't understand how it works, or it honestly is really hard to really teach people who are not really born into internet to use the internet. So those people are basically dead causes. So right now, in terms of how tech stock goes, the entire product growth situation is we're almost at the top where the growth is gonna either plateau or is just gonna go in a very constant in a decreasing accelerated fashion. What does it mean? Is the amount of growth, right? The amount. So let's just say previously you will have a at least plus 5% growth every single year. But as long when we're reaching this point, that means the annual growth is not going to stay at 5%. It's going to slowly and slowly decreasing to 4%, to 3%, to 2%, and to 1%. In general history, during the 1999 dot-com bubble burst, we see something like this. A bunch of dot-com stocks got crashed. And in here, tech stocks is going to be the one who got squeezed out. But the complication here is that tech companies are controlling too much of our lives. For example, Google, right? Google controls literally 80% of our online traffic, and you have Amazon who controls like 65% to 70% of our online shopping. So you guys are like, so we know that there's going to be a crash, and then we know that, macroeconomically speaking, for example, we all know that all of these tech stocks are overvalued. Everybody knows. If you go ask anyone on the street or anyone who was on Wall Street, everybody's going to be like, okay, if you work for a U.S. investment bank, they're going to be like, oh, it's fair value. But if you go outside of U.S., you ask any seasoned investors, they will all say tech stocks are extremely overvalued, because the way how we traded for the past 5 years on tech stock is we overemphasize how much growth they're going to have. But what we don't realize is a lot of developed countries are at a negative population growth rate. If you don't have enough people being born, how are you going to have enough users for a tech company to grow? So if you don't have enough users, what will the tech company do? They would expand, they will acquire other aspects of life. Therefore, it becomes bigger and bigger and bigger. It almost to an extent where it becomes a bank that is too big to fail. But we're not at that point yet. We're just not yet. So how does the government play a role in this? So every major crashes or bubble pop, it always follows a interest rate hike. Why would an interest rate hike? It's basically because a lot of things are overvalued, therefore it pushed inflation over and over to an extent where the federal government believes that with further inflation, the economy itself cannot sustain itself, and we're going to go into a stage of economy called stagflation, which means inflation is so bad that, if you make $1 today, you want to spend it right away. Otherwise, tomorrow the $1 is going to become 50 cents. I'm exaggerating, but this is what the federal government is worried about. So how are they going to deal with that? Is they're going to have better fiscal policy, which, let's just be honest, it's not really going to happen, because the political environment we have in the United States right now is actually working against the Federal Reserve's monetary policy. So the fiscal policy want to increase taxes, but when you increase taxes, it actually increase the burden of every individual taxpayers, right? And when you increase the burden of every individual taxpayers during a recession, that actually puts more burden on the economy, which means, think about it, right? I'm the seller, and then all of a sudden I have to pay 5% more tax. Am I gonna really take that 5% off of my paycheck? Of course not. I'm gonna let the consumers take the burden. So then the consumer will take the 5% basically pay cut, and then when the consumer get the 5% pay cut, they either reduce their consumption or they still buy, and then they demand their employers to give them more money. So then you go into this vicious cycle, and then there's gonna be less and less cash in circulation. When there's less and less cash in circulation, and then Fed has no choice but to increase interest rate. But when interest rate were increased, it also reduces cash in circulation, which makes the entire situation even worse. But if the Fed doesn't do that, it just worsens the inflation. Did you see the problem here? The problem here is that basically the Fed's hands are tied. They have to taper. They have to hike the rate. Otherwise, in a long-term perspective, the economy is just gonna go to shit. Okay, and if they don't do that, then it's just a dilemma here. Okay, so without going too deep into this, I'm just gonna tell you what really is gonna happen and what does it mean. Like, why are all these stocks are in the green and when all these stocks are in the red? The reason why all these stocks are in the red is because A, they're really overvalued based on user base and based on product base and based on growth. And why these stocks are going green is literally because they are, for example, Berkshire Hathaway is literally like 60% cash right now. And if you look at Morgan Stanley and if you look at all their reserves and a lot of these loan processors or basically banks, right? It's no brainer, right? Asset management and banks, except for Robinhood, of course, because people still see it as a brokerage rather than an asset management company. But think about it. If you're a bank, right? And if the Federal Reserve actually increases the interest rate, that means your profit margin will increase. So all of these sectors, the financial sectors, will make even more money when the Federal Reserve increases their interest rate. And who would in turn lose more money? All of these growth companies. Why? Because a lot of them are utilizing data or utilizing other means of financing, which essentially is based on the debt rate. So basically, every financing method have a based interest rate. And all of those base interest rates are based on the bond yield of United States T-bill. And because the interest rate would increase, therefore the yield curve would literally becomes less flattened out. And because taper happens, the yield curve would be less flattened out. Basically, it just means money becomes more expensive. And when the money becomes more expensive, all the tech stocks are going to lose significant value because all tech stocks requires money to make more money in a way where they don't get their money back immediately. But for financial institutions, it's their game to make immediate returns because when interest rate increased, when let's just say you take a loan beforehand, it was 2%, it becomes 3%, right? And the 1% seems so low, but 1% annually for 1,000 people, that's a lot of percent in a year. And this is literally how bank makes money. So this is what's going to happen. So if you don't listen to, if you can't understand what I'm talking about for the past, I don't know, 10 minutes, what you will know or what you have to understand is this is what really is going to happen. So here, one, it will be tech value goes into consumer facing industries. And the dilemma here is consumer facing industries has stagnant growth. Therefore, who will eventually be the winner? It will be the financial institutions. So the general strategy for 2022 is basically just load up on banks, right? When there's temporary correction, just load up on banks. And whenever interest rate hikes, so whenever rate hikes, equity drops. In return, banks will recover. They will be the ones that recover the fastest. And even break new highs. So then the homework for today is to figure out the valuation base for your tech company, for your favorite tech company. What does it mean is basically, let's take Tesla, right? Let's take Tesla as an example. So Tesla right now is traded around, let's just say 12. Yeah, that's where most people think it is trading at. And if you look at, option chain, even though right now the price is 11.50, the option deadlock is at 12.50. So let's just say fair value 1,200. Let's just be straightforward, 1,200. And what your job is to figure out how much does Tesla actually worth? Does it worth 900? Is the implied growth rate on Tesla overvalued? If it is, then by how much? And by understanding that, you will understand by the end of each incremental correction of 2022, when will be the best time for you to buy back in Tesla. Does that make sense? All right. Hopefully you guys love this video. See you guys on the upside. And remember to smash that like button and subscribe.